Hello all, welcome to this new EnergyScan webinar session. We are going to wait a few seconds to let more people coming in. Okay, welcome to those who just joined. It's now time to launch this new thematic EnergyScan webinar session. I'm Julien Waro. I'm in charge of the economic research team here at NG Supply and Energy Management. So first, happy new gas year to all, as we are the 1st of October, and this is officially the beginning of the winter season in energy markets. And today we will explore together some of the defining trends shaping the Chinese energy market. When China remains the top fossil fuel importer, it also holds the biggest hydro, solar, and wind installed capacities. And between a challenging economic outlook, a fast changing electricity market, the net zero target, and the need to ensure security of supply, we'll see that the Chinese energy picture is much more complex than it appears on the surface. In this session, I will be joined by the whole economic research team, Olivier Gasnier for macroeconomy and crude oil, Evariste Nyouki for gas and coal, Paul Chavy for emissions, and Luc Ruffie for electricity. So as usual, check out the buttons on the bottom right corner of your screen to ask questions to our speakers or chat with participants and leave suggestions to the team. We'll do two Q&A sessions today, one after the macroeconomic and crude oil part of Olivier, and one at the end of the presentation after the whole gas, coal, emission, and power presentations. I remind you that this session will last 90 minutes until 11:30 Paris time. Finally, you will also be asked to fill a one question satisfaction survey at the end of the session. The slides and a replay of the session will be available by tomorrow at the latest on the EnergyScan platform, but you can already download the slides by following the instructions displayed here. So click on apps, then handouts, and you should see the PDF of the presentation available for download. So let's now move on to the first part of this session with Olivier, but as usual, we will start with a one question poll to launch this webinar. So let me launch it. And this is a global question about your opinion on the Chinese energy transition. So according to you, what major challenge could hinder or alter Chinese energy transition? Is it first the difficult balance between economic growth and reducing CO2 emissions? Is it international trade tensions and notably the trade war with the US? Is it strong fossil energy needs despite the development of renewables? Is it the need to modernize and adapt electricity grids to integrate intermittent wind and solar power? And we'll see that this is a challenge. Or finally, is that linked to change in regulation and policy support? And we'll talk about notably the end of feed-in tariff for solar power that occurred recently in China. So let's have a look at the results. It's quite mixed with one third of you thinking about the difficult balance between economic growth and the reduction of the carbon footprint. That could be a major challenge for China. But we see also that we have one third of you thinking about that strong fossil energy needs will remain, and despite the development of renewables. So that's interesting, and be aware that we will tackle most of these questions today in this session. So thanks for those who took time to answer. So I think Olivier, it's now time to launch the first presentation with you.
Okay, hello all. Thank you, Julien. So yes, we'll start by macroeconomics as usual, and we'll say a word about the role of China on the oil market a bit after. So difficult to start a presentation about the economic situation in China without evoking the demographic situation. The population has already started to has peaked and already started to diminish according to the United Nations projection. The population is expected to halve in the next 50 years, which is huge, as you can see on the first graph. So there have been some measures taken by the Chinese authorities in the last decade. First, the abandon of the one-child policy that was followed in that was in 2016. That was followed in 2021 by the move to a third child policy but we haven't seen any concrete results of these changes. This is simply the illustration that the Chinese population doesn't want to have children anymore. I mean, it's a bit brutal to say that like that, but it's a reality. And so far there is no improvement on this side. That depends, of course, on the current economic situation, the housing crisis, on which we have a word in a few minutes. You can see the evolution of the median age of the Chinese population. Over the last 40 years, it has increased by 20 years. The trend remains about the same. The expected trend remains about the same for the next 10 years, for the next 20 years, where the median age is expected to increase by about 10 years. And the average, so the median age of the population should even reach a bit more than 60 years, which is really huge in the next 60 years. So that there is a considerable deterioration ahead for the Chinese demographic situation. What is interesting is to make comparison with old countries, if I can say that. So I've taken the figures from still from the United Nations about the prospect for Western Europe and also for Japan. Japan, who has already been facing a rapid aging of its population, and you can see the difference. I mean, it clearly illustrates the fact that the situation will really deteriorate in China compared to those countries. I mean, if you take, for example, the situation in Europe, you can say that the worst is probably already behind us. So, I mean, the situation won't really deteriorate from the current situation. It depends from one country to another, of course. For Japan, of course, the population will diminish, but the situation in China will be much worse, with really a quick deterioration, quick fall in the number of people living in China, and also a sharp increase in the median age, with, of course, big consequences for the growth potential, for the social expenditure, etc. So very worrying situation on this side. Second important topic, the real estate crisis. So I won't enter into details, I mean, about the situation on the Chinese property market. It would take too much time, but I mean, it's easy to solve that by the fact that there have been years of overinvestment clearly. And now there is a big crisis, and probably this is a long-term crisis. I mean, it's interesting to look at this topic, because each year you can take each year since 2020, 21, you have someone expecting a rapid recovery, a rapid upturn in the Chinese housing market, seeing signs of improvement, etc. And of course, that is not the reality. You can see really the collapse of activity through the evolution of the number of sales, or the housing starts. Of course, with no improvement at all for the time being. There had been first alert in the middle of the previous decade, and then a quick recovery, but that didn't last, and the bubble really burst after the COVID crisis. There was, if you remember, the collapse of Evergrande, the biggest property developer, that was followed in 23 by Country Garden, etc. So big crisis. If you look at the latest indicators, for example, the real estate climate that takes into account several key indicators about the housing market, you have even the feeling that the situation is worsening again. If you look at the evolution of new home prices in China, this is about the same. There had been quite a slowdown in the pace of decline in prices, and now again a kind of acceleration. So we don't see any quick improvement on this side. What we can say probably is that actually Chinese authorities have taken measures to counter the expected crisis in the housing market, even at the beginning of the previous decade, but in a way that worsen the prospects, because they have done everything to support property developers to avoid a big crisis, but that has delayed the adjustment on the supply side. There is an enormous amount of empty houses that have been built, etc. And so the stocks need to be to diminish, and so it will really take years to be solved. So this has consequences, of course, on the evolution of consumer spending. You can see that quite clearly on the left-hand chart that describes the evolution of retail sales, with a clear change of trend after the COVID crisis. If you take the average of the yearly growth rate between 2010 and 2020, we were close to plus 13% a year. And now, since then, this rate of growth has diminished to less than 4%. Okay, I mean, if we exclude the period of with the lockdown, etc., linked to the COVID crisis, if we just take the numbers since 2003, we have nevertheless a growth rate that is less than 5%, so considerably weaker. There has been support. I mean, as I said, support for to encourage people to have children, support to in terms of credit distribution. But when you look at the evolution of credit, you can see that there has been a clear acceleration recently that probably seems to tell us that GDP growth should be supported in the short term to stick to the official 5% goal. But when you look at the breakdown of this credit distribution, you can see that most of this credit acceleration is due to acceleration to credit to local authorities, for example, and that supports actually spending in infrastructure. But on the consumer side, there is only a very very slow rate of increase, and that has absolutely nothing to do with the rate of growth we could observe in the previous decade. So consumer spending is weak. Consumer spending growth is very low, and we don't see any improvement on this side. This has also consequences about on the structure of course of growth in China. So there you can have a look at the graph on the right. I mean, I have split just the contribution to growth to GDP growth between domestic demand, I mean consumption plus investment, and net exports. And you can see that the latest trend is clearly that growth is more and more dependent on net exports, because both on the weakness of imports and also the robustness of exports, and on the domestic side you have a trend, a downward trend that seems resuming. That was already at play before the COVID crisis, and so after the up and down linked to the COVID crisis, probably this downward trend will resume. So of course less investment linked to the crisis in the housing sector, but also less consumer spending. We can think probably that GDP growth around 5% is in real terms, so in volume, is overestimated. That appears quite clearly on the graph on the left, where I have the split the nominal growth between volume and prices, and you can see that on that corresponds with, for example, inflation data that show that prices are down or at best around zero. That GDP prices have diminished over the last 2 to 3 years. So of course, when the Chinese statisticians make the split between volume and prices, I think there is a bit of incentive to put a bit more volume than probably that corresponds to reality, and this is why. And this is what leads me to think that probably real growth is a bit overestimated. So the fact that so we have seen that of course net exports takes a bigger importance to explain the GDP growth. That is clearly a problem in nowadays, because of course you have the trade war that. I mean, even before talking about the US trade war launched by Mr. Trump, that has fueled increasing tensions with Chinese trade partners because of this aggressive policy to boost exports towards the US, Europe, etc. So I have put 2 graphs on this side. The graphs on the left describe the evolution of customs tariffs between China and the US since the start of the second mandate of Mr. Trump. If you remember, during the first mandate, there was already a first period of trade war, but that was not on that scale. So you can see the evolution of tariffs implemented in the US first. So the 10% 2 times linked to supposed fentanyl exports to the US, and then the escalation because after the 2nd of April, China has been the country implementing tariffs against the US, and so there were decisions by the US administration to increase sharply the level of tariffs on Chinese products, leading to a completely ridiculous level of taxes, 145 percent against 125% for US for imports of US products in China. There have been discussions and so an agreement to open a negotiations period for 3 months. That led to the start of August, and this negotiation period has been renewed to another 90-day period. On the next deadline is on the 10th of November. That has not prevented the US administration to take other measures, such as implementing 50% on steel and aluminum imports or copper products imports, etc. So, and there have been estimates by the Peterson Institute, for example. According to the, I mean, they have made a very wide and big work about the each class of products imported by the US, and they consider now that 100% of Chinese products exported to the US are taxed. And the average rate is not at 30% as it seems to be the case as shown in the graph, but it's closer to 60% actually, because the starting point was already at close to 20% at the beginning of the year. That was the consequences of the measures already taken during the first mandate of Mr. Trump and confirmed during the Biden mandate. So, yes, this has big consequences. You can observe on the graph on the right the consequences of all these measures already on the breakdown of the Chinese exports, and you can see clearly. So, of course, the first obvious conclusion is that there is a clear slowdown in exports to the US. And also the second consequence is that there is a sharp acceleration in exports towards other Asian countries. Why? Because, I mean, the strategy is to avoid sanctions directly imposed to Chinese products by, I mean, re-exporting Chinese products via Vietnam or other South Asian countries. And also there is a clear push on Chinese exports towards Europe. And of course, that triggers responses from Europe. So the trade war is not only with the US, but there are also tensions with Europe taking action against Chinese product. And also there are big pressures imposed by the US administration on other countries to take measures against China. And a big illustration of that was the recent decision by Mexico to tax imports coming from China. I guess that probably Canada could do the same. There are big pressures imposed on other countries such as Europe to tax Chinese products because of the Chinese imports of Russian oil, for example. So this is I mean, it's not really, it's not strictly speaking US against China. It becomes also China against the rest of the world. And part of that is also due to the domestic situation in China, where domestic demand is weak and weaker now, and they have to rely on the strength of their exports to the world. In terms of GDP growth, I have just put the classic table that you can find in our monthly report, showing that in the short term, I don't think that there will be much problem to reach the 5% GDP growth goal, as we have seen. Next year, I think it will be much more difficult. I think they will probably change their goal and they will have to reduce it to, let's say, for example, 4.5% or something like that. So due to the constraints imposed by the demographic evolution, etc., the housing market crisis, the trade war, you can only expect Chinese growth potential to diminish. To this respect, for example, if you take the IMF's forecast, for the rest of the decade, they expect Chinese growth potential to be a bit below 4%, and for the following decade to be between 2.5 and 3%. I still think that is rather optimistic given what we have seen in terms of demographic projections and the growing tensions linked to the fact that the Chinese growth depends on its exports. So we can now have a word about of course, about the oil market. First slide, just to remind you what you probably already know, that China is, of course, due to the size of its economy, but it's a major player in the oil market. In terms of consumption, it comes second behind the US. In terms of imports as well, China is the main crude importers. It has big refining capacity, so this is less the case in terms of oil products, but really, I mean, for example, it's true that the discussions recently have more focused on India due to the sanctions taken by the US against India, because India has imported a lot of Russian oil since the start of the war with Ukraine, because it's cheaper, of course. But in terms of volume, I mean, the Chinese imports, they are about 2.5 times the volume of imports by India in terms of imports of crude. So that China remains really a key actor of the oil market. And what is also remarkable is that it is the case despite the rapid development of renewable energies. We'll see that with my colleagues. And it's also interesting to keep in mind that, for example, compared to Japan, I mean, if you want to draw parallel with the Japanese situation, the deflation, the housing market crisis during after the 1990, it's not exactly the same situation, because there is still a catch-up effect, I mean, for China. I mean, if you look, for example, at the level of GDP per head, if you take, for example, the purchasing power parity numbers, the level of GDP per head in China, it's about 1/3 compared to the US, or less than half of the level of GDP per head in France. Of course, there are big disparities between the urban population and the population living in countries, etc. So it on the countryside, but it's important to have this in mind, that there is still a catch-up effect that will support notably the energy consumption in China. Something important to have in mind is the breakdown of crude oil imports in China, and especially the importance of country under sanctions. So you can see it's difficult a bit to read maybe the graph on the left, but you see the main countries exporting oil towards China. These are Kepler figures. I've forgotten to put that on below the graph. So Saudi Arabia, Iraq, Russian Federation, Angola, Oman, Brazil, Iran, United Arab Emirates, Kuwait, Venezuela, on others. So if you take the sum of Russia, Iran, Venezuela, the countries under international sanctions, that results in about almost 25% of the total of Chinese imports. This is not nothing. This is clearly significant. I think it's interesting because this is on the one hand, it adds to bargaining power of China. I mean, bargaining power in the trade negotiations with the US, etc. Because of course this will be part of the negotiation. On the other hand, it tends to jeopardize a bit the energy security of China because they could suffer from really, very tough sanctions against the exports of these countries. You will tell me that it's already the case, but I mean, you could imagine that if there are really sanctions against key Chinese companies, etc., that could have that could be more effective, if you want. I mean, so that's also a risk for China to have 25% of its imports of oil that come from those countries. And finally, this is the last slide. I mean, I try to reassure Julien, who probably thinks I will be too long. There'll be something interesting. I mean, you know the story. I mean, we are in a state of. I mean, the oil market is in a state of oversupply, and that has started as soon as the first quarter of this year, and this is expected to worsen until at least the first part of next year. You can see that very clearly. I mean, this is the balance between total demand and total supply, and the stock build will be enormous between, I mean, over this 6-quarter period. So we have observed effectively a decline in prices, but I mean, it has been relatively limited, and since it has been interrupted since the end of the first quarter, which was not really expected, all the more because you know that OPEC has, on top of that, significantly increased its production on showed willingness to continue this trend. This contradiction can mainly be explained by the fact that China has bought a lot of oil on to increase the amount of inventories they have. There have been an estimate of given by the International Energy Agency. They think that 90% of the excess supply in Q2 has been absorbed by China and absorbed by an increase in Chinese inventories. The problem is we don't know, we don't have official figures for Chinese inventories. So there have been many estimates about the increase in Chinese inventories in the start of the year: 150 million barrels, 200 million barrels, even more than 500 million barrels. We don't know exactly. We don't know exactly the level of inventory capacity in China. So it's difficult to. I mean, the key question now is: will China continue to absorb this excess supply surplus, with a major implication, of course, for the evolution of prices? But we don't know exactly. We don't know how to answer this question. We can, of course, say that China has increased the level of inventories to benefit from low prices, especially from Russia, for example, to improve its energy security, probably linked to the evolution of its trade relations with the US. There are some people thinking that maybe China, the only reason for China to increase to such extent the level of inventories is to prepare something very bad with Taiwan, for example. So, I mean, I'm just trying to give all the reasons that are evolved about that. And there are other thinking that China are just trying to diversify its asset between gold and Como, etc., compared to the US dollar, simply due to also to the deterioration of the relation with the US. So many reasons, whether they are correct or not, I mean, we don't know exactly. So this is a bit unknown for the future or the evolution of prices linked to what will do China in terms of accumulations of inventories. I think I'm done, Julien.
Yes, thanks a lot, Olivier. Time flies, for sure. Just one quick question regarding China crude oil demand. Can we expect a significant upside in the coming years? I mean, despite the electrification of a significant share of vehicles in the country. Do you have an idea on this? Or?
No, yeah, but the prospect is more about, I mean, stabilization linked to precisely, I mean, the two opposite effects. On the one hand, you have, of course, the move towards renewables, etc., so less use of fossil fuels. And on the other hand, what I said about the fact that the catch-up effect in terms of increase of the population revenues and their access to higher level of consumption, etc., that will continue to support the use, the consumption of oil. So the prospects are more about a kind of stabilization of the level of oil demand in China, but probably that can evolve quite rapidly depending on the balance between those two effects.
Okay, thanks a lot, Olivier. It's time to switch to the gas and coal part with Evariste. So,
hello,
floor is yours.
Okay. Hello, everybody. So to make the transition, we'll talk about Chinese GDP first, with the graph on the left, which show that Chinese GDP increased very, very significantly when China joined the World Trade Organization. It was in 2001. And at that time, you see that industry represent the higher share of GDP. But gradually, and from 2011, we see that the service sector takes the lead. So the Chinese economy is now more service-oriented. Service-oriented means less energy-intensive activities, and you can see it as a result on the graph on the right. There is still a strong correlation between the GDP and energy consumption, but you see that the link is weakening a little. It is weakening. Olivier talked about the official 5% GDP growth this year. Probably they will reach it. In the years to come, probably this should remain the target, although, yes, you can assume that economic growth will slow down a little. But what we assume is clearly that although the economy could grow at 5%, we don't expect energy consumption to grow at 5%. So for us, we believe that now the more likely figure is rather the 3%. And if the GDP growth is weaker than the 5%, you can even drop below. So this is for total energy consumption. When you move to electricity, you can still have a higher growth rate. And you can see it on the graph as well, with the green line being above the orange line for GDP and the blue line for total energy. Why? Because the population becoming richer, okay, the population use more electric appliance, domestic appliance that consume electricity, and not to mention electric vehicles, of course, because this is also likely to increase electricity consumption and disconnect, why not, the electricity consumption growth rate to the GDP growth rate. So structural changes on the GDP means structural changes on the mix of energy as well. On the graph on the left, you see the strong drop in the coal share. Yes, but remains rather high. The stabilization of oil and even a slight drop for oil. Renewable are increasing, but you see that there is still rather weak. But when you move to power generation on the graph on the right, here you see the impact of renewables. The share of renewables is clearly increasing a lot. And when you hear what Chinese authorities are saying, they are clearly stating that their target is to make a transition toward a renewable-based economy while avoiding sharp price fluctuations. Renewable-based economy means more power generation, so increasing the share of electricity in the energy mix, with this electricity being fuel produced by renewables. So clearly this is the target. There are some challenges, but those challenges, and you'll see it clearly, Chinese authorities will tackle them by trying to mitigate the price fluctuations. So let's start with gas first. Since the start of the year, China domestic production, gas domestic production is strongly up. We are talking about 6%. Pipeline imports are also strongly up. Think about power of Siberia, flows increasing. Last year, Russia sent to China via this pipeline 30 BCM. This year, the volume should increase to 39 BCM. So with the combined increase in domestic production and pipeline imports, there is little room for LNG imports. Since the start of the year, LNG imports are down by 13 BCM. Even if you assume that for the remaining of the year, we'll have a stabilization of imports, we could still reach a drop of LNG imports, which could be significant this year. At the end, when you make the sum of the three components, you will still have an increase of total gas supply of around 3%. 3%, when you look at the graph on the left, it may seem strong, but it's not so strong because in the previous years, at some point, gas consumption was increasing much higher than, stronger than energy consumption. This will be the first year where you are seeing gas increasing rather similarly than the total energy consumption. If you except of course 2022, and you can imagine why. So this is a major change for the gas market, in fact, with gas consumption increasing not so much compared to the global energy consumption. Moving to demand. Of course, when you look at the graph on the left, it gives the split of Chinese domestic gas consumption. Yes, you have power generation, which clearly is impacted by the fundamentals of the power market. You have also some part of this consumption which is impacted by the GDP, in particular consumption from industry. And you can notice here the slowdown we had in 2022. At the time, the GDP growth was weaker. Clearly, energy consumption in industry was also lower. So this component is clearly the most impacted by the GDP trend. And then last but not least, you have consumption in transport. We make here a focus with the graph on the right. You have to know that LNG is imported in China. Part of this LNG is put on the grid, on the pipeline grid, but part of this LNG is consumed as LNG, particularly on the transport sector, to fuel the LNG trucks. This component is now a major component in Chinese gas consumption. And this one, as you can imagine, is impacted by the spread between the oil and the gas price. The higher the spread, the more LNG is competitive compared to diesel, and then you increase the share. but it also explains why. And you know that we, in the past weeks, we talk a lot on our publications on the strong link between gas and oil. This is also an element that explains that strong link between the gas and oil, because in China in particular, for this part of demand in the transport sector, you can have some substitutions. So this is for gas. When you move to coal, you see as well that China has some options. The first option is clearly the strong domestic production, and the other one is the coal reserve they are trying to put in place. Since the start of the year, China domestic production is increasing while imports are falling. But now for the remaining of the year, we expect the two trends to diverge. We expect lower domestic production and higher imports. Why? Because Chinese authorities recently were trying to fight overproduction and also to improve safety at mines to avoid a fatal accident. So for the remaining of the year, clearly production is expected to slow down. And of course, you'll have to compensate this slowdown by increasing imports. So this is what we expect for the remaining of the year. And in the years to come, we expect that Chinese authorities will continue to fine-tune the two elements between domestic production and imports, depending on global market conditions. Don't forget what is mentioned on the title. They don't want price fluctuations on the global market. If imports were to hurt the Chinese market via volatility in prices, they will increase their domestic production. Clearly, they will adjust domestic production to what is happening on the global market. And as I say, on top of that, they are now on track to put in place this reserve, a very huge coal reserve of about 300 million tons to be ready by 2027. And clearly, what they say is that this is to be used during extraordinary circumstances. These include severe supply fluctuations, of course, or if you have very extreme weather or major supply setbacks. Again, the message is clear. Yes, to import on the global market, but at any cost, we don't want to pay a high price. The survey at the beginning showed that most of you share this comment on the title. Despite the development of renewable energy, we expect fossil fuel needs to remain high. And to explain this, we'll start with the recent comments made by the Chinese president. With a strong target for renewables, increasing wind and solar capacity by 155% from 2024 to 2035. Of course, this is capacity. It doesn't mean actual production. To convert it to actual production, you must take into account the capacity factor, which is around 22% for wind and 11% for solar. But if you do that, you can compute what we expect in terms of wind and solar. And then what we did here is just to make some other assumptions for generation from nuclear, for instance, not so strong for hydro, for geothermal, and also some increase for biofuels. So taking again the assumption about a 3% increase in energy, total energy consumption, then you can subtract those volumes coming from non-fossil, and you can compute the total fossil needs. And this is given on the two graphs. On the top, you have the non-fossil, and then you have the remaining fossil needs. You see that they are still very high. So you have the values here in terawatt hour. And what we did between 2024 and 2035, and what you did, you say, okay, imagine you take all those needs only on gas. This will represent around 114 BCM per year on average of additional gas consumption. Or you say, no, I will take it via coal, and then you have 167 no, it's not ton, it's million tons, sorry for the mistake, million tons of coal until 2035. For sure, they will not decide to go only for coal or only for gas. It will be a mix of them. So to decide what will be the actual share on those mix, you can move to prices. And the message here is clear. Yes, okay, we'll take more from the gas side if the gas is competitive. The gas could be competitive thanks to Russia. Arctic LNG 2 deliveries, so that they are ongoing, putting pressure on gas prices. Shortly after the delivery of the first cargo of Arctic LNG 2, Russia and China decided as well to increase the flow via the Power of Siberia 1, and they are talking now about launching Power of Siberia 2. If all those volumes come in the market, they are likely to put a strong pressure on prices, and why not push prices down to the US short-run marginal cost? Look at the two graph, the graph on the left. The light green is the short-run marginal cost to Asia. Okay, we take only here the entry price, you take as well shipping to Asia, regasification costs as well, and you have the dark green, which is the long run, where you include liquefaction. You don't consider liquefaction here to be a sunk cost, you include it. So when competition is strong, so economics tell us that prices tend to drop to the short-run marginal cost. So if it is the case, gas could be as competitive as coal, because the gray line is the API2 cost, Australian coal, including the CO2 cost. Paul will develop about the CO2 cost in China later. And this is the price for power generation. So if competition pull prices down to the level of the coal price, China will say, okay, I can make easily my transition because I can not to hurt my economy, my economic growth, and at the same time switch from coal to gas. So to me, this will be the key factor. How will Russian gas impact the global competition? If it drives prices down to the end-year price, the short-term marginal price, yes, China will gradually switch to gas and probably increase the share of gas in its energy mix. So that's all for me, Julien.
Thank you, Evariste. So as I mentioned at the beginning, we will do the Q&A session at the end of the presentation for the gas, coal, emission, and power section. So don't hesitate to put your questions in the question menu. So thank you, Evariste. We will see you at the end of the presentation. So let's switch now with Paul on emissions. Hello, Paul.
Thanks, Julien. Good morning, everyone. Yes, so now we're going to talk about China emissions and the drivers behind China's emissions and driving the net zero path of the world's largest emitter. So we're going to talk about the Chinese ETS and how the ETS is designed and how it's evolving, the recent market price dynamics, and what's next for China and the main challenges for tackling emissions. So this was last week. Chinese President Xi Jinping announced the country's national determined contributions at the UN Climate Summit. So the core is to cut greenhouse gas emissions by 7 to 10% from the peak by 2035, and to expand the share of non-fossil fuels, including renewable energy, to 30% or more. So this is the first time that China has presented specific figures for its greenhouse gas reduction target. So this is clearly an important historic moment in the end. So, but as we can see here, so this is China's emissions since the 60s. So emission has surged in the beginning in the 2000 years, driven by, of course, rapid industrializations and urbanizations, but has not peaked yet. So it remains the question that is this target achievable for China, and what does it mean for China's CO2 very intensive economy? First of all, this is China's share of emission in the world. I wanted to put that in perspective to have a bigger picture of what are China's emissions. So as you can see on the chart on the left, China accounts for almost a third of global emissions. So far ahead from the EU, the United States, or even India. So China's emissions overshadow most other countries. And so any global climate solution must involve China at the very center. So amid that 11,900 million tons emissions, power, as you can see on the chart on the right, is the backbone of emissions, with approximately 60% of China's emissions coming from power and heat. And from that, there is a small part, the smallest power plants that are not included on the ETS, but the ETS covers approximately more than 5,000 million tons emissions. So almost half of all China's emissions, which is clearly huge. And if we zoom in again, in China's CO2 emissions, we have power that accounts for a lot of emissions. We also have industries, but we'll now focus on what is covered by the ETS, which is the power emissions. And if we look further, the China ETS tackles coal and gas power emissions, with coal being by far the largest component of emissions here, as you can see. And that's what we will try to scrutinize in, later on. So as you can see, coal power plants covered by China's ETS represents roughly the emissions of the EU or the US. So this is very important to incentivize to reduce coal emissions in terms of the global emissions worldwide. So now we'll dive into the coal emissions and the coal-fired power generation. So it's been quite hard to decrease, as you can see on the chart on the left. So this is fuel-fired power generation, but as you can see, it's mainly coal, and there hasn't been any slowdown. It's almost at its peaks. Coal plants are difficult to phase out. Many are relatively new, capital-intensive assets designed to operate for decades. And this lock-in effect makes it challenging to shift generation to less carbon intensive sources, and complicates, of course, decarbonization efforts. So furthermore, China has extreme seasonal conditions. It amplifies this challenge. So as you can see, I put on the left chart the heating degree days and cooling degree days of China, with quite cold winters on summers that are far hotter than in Europe, resulting in higher heating and cooling degree days, and in very pronounced shoulder months. But yet, as you can see, this seasonal pattern is slightly seen, but not clearly reflected in coal-fired power generation, highlighting the fact that the country's strong reliance on coal on the power generation. And that's why an ETS is needed because coal remains the backbone of the system, and an ETS is needed to put a financial incentive to reduce coal emissions. So now moving on to Chinese ETS. So the China announced its ETS in 2017, and it launched in 2020 in July 2021. As you can see, the price here on the right chart. It is now the world's largest carbon market, covering more than 2,000 power plants and about 40% of national CO2 emissions. But design matters. Indeed, it is clearly different than the European Union ETS. Because unlike the European Union's cap and trade model, China's ETS is intensity-based. And this is very important, which means that allowances are distributed according to emissions per units of electricity and not an absolute cap. So efficient plants are rewarded, while inefficient ones face higher compliance costs based on a benchmark. We'll talk about that a little bit later. And so this is the key difference, and it's very important to understand the Chinese ETS. So this improves efficiency, but doesn't yet guarantee absolute emission cuts. That's a key distinction because the market relies only on free allowances and not auctions, which means that the more efficient the coal plant is, the more free allowances it gets. And last but not least, it also means that there is no need for a market stability reserve like there is in the EU ETS, because as there is 100% free allocations, it plays this role of stability reserve. So now, if we zoom out to allowance prices, because the price is the main incentive, it's quite different than in Europe, because as we talked just before, coal is 95% of power emission. So the fuel switching incentives that we have in Europe, that's used to switch from gas to coal based on the price of emissions, here is almost non-existent, because gas-fired power generation represents only so few capacity compared to coal capacity. So the price is mainly driven by the level of free allowances given. So as you can see, at the launch, there was a very long range where the price did nothing between beginning of 2022 and 2023, and then prices was sharply because the benchmarks were tightened, and thus reducing free allocations, and the borrowing from free allowances was creating immediate compliance demand. As you can see, prices was from 60 yuan to more than 100 yuan per ton. So that's approximately a rise from 7 euros per ton to 13, 14 euros per ton. And furthermore, also it improved the confidence in the market, and the volumes increased very, very sharply in 2023. And here, so fast forward to 2025, there was the announcement to expand China's ETS to industry, which implying generous free allocation in the beginning of the phase out of industry. We'll talk about that a little bit later. And so weaker demand compared to supply. And one reason also is more economic slowdown that have reduced emission growth, as we've seen with Olivier. So the market is evolving stronger than at the start, but still not as tight as Europe's ETS. And as China power demand is still growing fast, the idea being that the intensity-based cap type is that to accommodate that fast-growing power demand as a hard cap on total emission, it would lead to constraining that power supply growth. So now on on coal plant incentives, so maybe we'll look more to this intensity-based mechanism. So here on the chart on the right, it's a map of Chinese coal-fired power stations. So as you can see, they are very concentrated on the rural area, and they are divided in 3 categories. So subcritical, which are power stations that have less than 300 megawatt capacity, supercritical between 300 and 600, and ultra supercritical above 600 megawatt capacity. And so China's coal fleet is very diverse. Sorry. So the subcritical plants are the least efficient. So basically the oldest one, while supercritical and ultra supercritical designs are far more efficient. And so this different type of coal plants means different incentives, as ultra supercritical are usually less carbon incentive. As you can see, there are 3 different benchmarks for coal power stations, and therefore 3 types of incentives. So under an intensity-based ETS, in each category of unit types, less intensive coal power plants are more rewarded in full allocation than those in the same unit type. So if we zoom in on this different type of coal power plants, as you can see, the fleet is quite well balanced on the right chart between subcritical, supercritical, and ultra supercritical. It's with almost a third from all the power plants. And it's highlighting, of course, the fact that in the end, there is a need for different benchmark. It's important because not to weigh too much on subcritical small power plants that are more carbon incentives than the new one. Because as you can see, most of the fleet is now between 0 and 20 years old. As time passes by, there will be less subcritical and more ultra supercritical that will be more efficient than the first ultra supercritical, and therefore creating an incentive to reduce emissions because they will be inferior to their benchmark. So in the end, the price should go down in terms of carbon price because as the fleet is becoming less carbon incentive, so under the benchmark, it provides more free allowances for those power stations. And as we've talked earlier, it has the benchmark has already been adjusted, so the price will depend a lot on the benchmark, and of course of what the Ministry of Ecology of China will decide on the benchmark for the coal power plants. So in parallel, this is China power supply stacks. So as you can see, it is clearly still dominated by coal. And so the ETS threatens the economics of renewables, tipping the balance further in favor of solar, hydro, and wind. And as you can see, so yes, you can see on the graph, it's mainly driven by coal for now. But in the past, 10 years, now there's been an incredible surge of renewable, with, of course, now the ETS favoring even more the incentive to use renewable energy, of course. And as you can see on the chart on the right, the growth of renewable is clearly astonishing in terms of if we look at the average wind year-on-year growth and solar year-on-year growth, we are approximately between 20, 30, 35%, which is clearly very impressive. And I assume Luc will talk more about that in the power section. And as we talked earlier, there are power emissions, but industry is also the second largest scope of China's emissions. So The news came on March 2025, and the Ministry of Ecology and Environment officially announced that the expansion of the ETS to steel, cement, and aluminium. So this was a historic moment because this sector accounts alone for 25% of China's CO2 emissions. So how this allowance will be determined? So it's actually the same as for power. So the ETS will continue to locate allowances based on production output rather than setting an absolute emissions cap. So the plan sets out a two-phase implementation of the ETS in the new sector. So between 2024 and 2026, 2025 sorry, and 2026, it's to familiarize companies with the ETS, and in 2027 it aims to tighten and further improve the system. So as you can see on the chart on the left, so this is data from the National Bureau of Statistics of China. The industrial output in China is still expanding very fast, approximately at a 5% year-on-year growth rate. And this growth mainly comes from high-tech manufacturing, electronics, EVs, batteries, and solar panel. But if we look at the biggest emitters in China industry sector, it is still the cement and steel sector, which is mainly used for construction and real estate. And as Olivier pointed out, a sector that is right now in great difficulty. So that's why we can see that actually Chinese emission in the cement and steel sector has already peaked, it appears. So this industrial expansion, even if it's a stagnant sector, it's still by far the most emitting country of that sector in the world. As you can see, the chart on the left is China's cement production in the world. It's still half of the cement production in the world, and for the steel production it's still more than half. So these emissions need also to be tackled, and there is a need to put an incentive to reduce these CO2 emissions and to put in place. So to conclude, the Chinese ETS is now the world's largest carbon market, but its design reflects China's unique challenge, which is meeting rising energy demand while steering a coal-heavy system toward greater efficiency and eventually lower emissions. And so the intensity-based approach does reward cleaner plants, but doesn't yet cap total emissions, making expansion to industry both critical and complex. So ultimately, the future of decarbonization will depend, of course, on China balances economic growth, energy demand, and climate ambitions. So this is all for me. I think I can leave the floor to Luc now.
Thank you, Paul. Hello, everyone. We'll move to the power section. So first, I wanted to go back to where demand is located and for what electricity is used. So Evariste and Paul already mentioned it, but China is obviously very industry heavy. But at a global scale, it has a consumption in 24. That was about a third of the global power demand. So that's about 2 times what the US consumes, or 2.5 times what Europe uses in a single year. So it's a huge market with lots of potential, but some underlying changes that are worth highlighting. You can see on the left chart that industrial is a big part of demand, but other sectors are also rising. As Evariste mentioned, the services are developing in China. So you have more of the commercial and public services and also residential through a greater electrification of appliances and better standards of living, basically. One thing that's also very interesting to highlight, in my opinion, is the distribution over the country of where demand is located. So on the right chart, you can see a density of population with basically 90% of the population located in the coastal areas, where the industry is also located, while on the west, it's more rural with deserts, high mountains around the Himalayas. So very different types of demand distribution in China. The demand in China is also evolving rapidly. You have really fast electrification happening. If you look at transport on the left side, you can see the share of EVs in the total car sales. So as an example, I put Norway as well, which was and is still a leading market, which is far more advanced. But also compared to other countries, China is actually leading the electrification of its transport sector, way ahead of some European countries and the world as a whole. So there is going to be growing demand from this sector. There's also obviously a stock effect, so it's going to take years to replace the internal combustion engine fleet, but it's going to catch up in the next decade. An interesting also trend is the rise of e-trucking, with the battery manufacturer CATL and its CEOs aiming for 50% market share of e-trucks by 2030. This was usually an application which was really hard to decarbonize or electrify because of the heavy upfront cost for e-trucks, but falling prices have really helped on this side. On the residential sector, you have an interesting point is that a lot of households are equipped with AC, not far from the American figures. So that leads to strong seasonality with high demand peaks in the summer. And I was also thanks to rise in the standards of living and purchasing power of the Chinese population. On the industry side, electricity for the past 2 years have been now the first energy input. Coal is the second one, obviously. There's been growing electrification in this sector, thanks to low-hanging fruits in a way. Some applications are very easy to electrify, while others, such as steel making or cement manufacturing, are very heat intensive, and fossil fuels are more prone to fulfill that role. Electricity is a bit less competitive in those sectors. So there's potential to electrify more in the industry, but it's not necessarily the easiest, or the trend might slow a bit in the industry. Data centers are a bit topic as well. Estimates vary widely in terms of actual demand, around 100 to 200 terawatt hours, but forecasters agree that it could double or even triple by 2030, but it's still a relatively low level compared to the overall consumption of the country. It's 1 to 2% at current levels. So yeah, electrification in China is has a good pace. It's going to keep going. It's actually already ahead of other economies in terms of total energy electrification. Now, if we move to the supply side, obviously coal, as mentioned previously, is a leading energy input, but the most striking one is that the share of renewables is rapidly increasing. That's a trend, and the share of coal, on the other hand, is decreasing. We see the pace of growth of coal is still there, but it's slowly, it has a lower slope. And actually in 25, we might see the first signs of peaking for coal generation, with current year-to-date figures for coal generation being actually lower than in 24. Now, if we focus a bit more on the renewable side, the rise of especially solar generation has been really impressive. Compared to 2020, installed capacity have risen more than 5 times for solar generation, or at least installed capacity. That's currently about 67% of the global solar capacity. That's absolutely huge. One driver that can explain it is the rapid fall of the PV module prices, as you can see on the left side, which over the years have really crumbled. This is a log scale, so that that's even more impressive. And PV and wind are actually more price competitive than any fossil fuel type of generations, such as coal or gas. But obviously, they come with drawbacks such as the intermittency and how to distribute this energy to the end customers. Yeah, and one last point about PV is that a similar trend has been observed, as in Europe, at least. Distributed PV, so close to demand centers on people's roof or commercial buildings, have been increasing and are a big part of those PV additions. And there are about 40%, 25% of what the installed additions were. Now, if we look at where at the renewable potential, I keep in mind that demand is actually on the coast, on the east side, while actual PV and wind demand potentials are more on the west, so around the Tibet or in the northern part of China. So basically, you have an imbalance between the supply regions and the demand regions. So you need to be able to funnel and transport this power to where the power is needed. There's also the hydro potential located near Tibet, or more on the central part of China, let's say. But you still need to power this to have the assets to transport this electricity. So one way China has dealt with this imbalance in terms of physical imbalance is to develop an impressive networks of ultra high voltage transmission lines. Can be DC or AC depending on the distance, but that's one way to transport this electricity that was needed for the demand centers. That's still in a way insufficient, as the curtailment rates in the the supply rich areas such as the north or the west are increasing year on year. So there's still a big challenge to transport this electricity. It takes about 3 years to develop and construct the lines, which is much longer than the time to develop a PV plant, for instance, which is typically around more like a year. Yeah, and so how can you help finding a balance between the supply and the demand? One way is to installing more batteries. A trend which is similar as what we can see in Europe or the US. Installed capacity in China is actually huge. It's about 60% of the total storage capacity worldwide, and it is ramping up at a really impressive pace as well. And China has a competitive advantage over other markets, as it has domestic manufacturing capacity to produce the batteries, from refinement of different minerals or assembly of the cells, and also for the production of solar panels and wind generators. So there's it has the power to actually meet its green ambitions thanks to this impressive manufacturing capacity. A word on regulation, which is very interesting as well. It's a core part of the transformation that is ongoing in China to better balance the grid and to better match the generation to the demand. Usually before 2019, there was a fixed price, which is a coal benchmark, which was set by the provinces. So very rigid format. And the generation was sold through a medium to long-term contracts, bilateral agreements. And the power was to be delivered directly without any, or without much adjustments. But now China is really and is moving fast towards shorter markets. So it's developing spot and real-time markets. Downstream clients can now access different delivery profiles, so they are likely to become more price sensitive. That's going to be used for EV charging. There's an introduction of the capacity market for coal generators, so they will be able to have another revenue stream, so that they don't necessarily have to use the plant on as many hours as before. Because before they were only relying on the energy cell, not the capacity they were providing to the grid. So there are really this big shift from a very centralized, highly regulated market to a better empowerment of all the participants, both on the generation and the supply side. Renewables were also impacted widely this year in June, as the previous feed-in tariff switched to more like a contract for difference style, which does not shelter as well the renewable assets as before. And so the target price is a bit province dependent, let's say, but still there's more risk linked to the exposure to the spot market. And lastly, to conclude on the outlook for China, we have seen this impressive rise in the renewable generation and capacity. It's still expected to continue, although at a milder pace, because there was this renewable rush in 25, especially for solar. It's similar in a way to what was observed in 21 for offshore wind, where developers were rushing to put on the market, to put online some assets. Coal is still set to grow, because you still need this backup for the grid, and demand as a whole is still going to grow about 6% last year, and it's still expected to be the same according to the IEA for the next 2 years. So the Chinese are pragmatic. They are not willing to sacrifice supply security, even if that means using more coal. And also, I'm going to conclude on that. The industry in China is just so important that the prices are a huge topic for the regulator. They don't want prices going crazy, and they need for them to be competitive to other markets. And that's actually one good thing that the renewables are going to do. They're going to pressure prices down, as we can see in other markets. So there is high scrutiny on those topics. Back to you, Julien.
Okay, thank you, Luc. So just before we do a quick Q&A session, I will launch the satisfaction survey for you. So please take a few seconds to answer it. It's very valuable for us to have your feedback. So back to you, Luc. One question on this power part. One figure that I found very interesting is the curtailment rate of solar and wind at 6%, despite a relatively strong growth in power demand in China. So finally, will this renewable integration issue, this grid constraints, will this be a main limiting factor for power demand and the deployment of renewables, which finally could keep a relatively strong demand for coal and gas for power generation? What do you think about that?
So there's you're right. There's the physical reality of how to flow all the power from let's say the west to the east. So in some locations it can be a capacity issue, but there's also a more regulatory issue in the sense that coal generators are sometimes asked to generate, and they sell their power outside of the spot market, so there is no any incentive for them to shut down. And with prices crashing on the spot, that might increase the curtailment rates for solar and wind assets. So there's this, with the shift and the reforms for the power market, there's going to be a better match in the future between the demand and generation, so likely lower curtailment rates if the investments keep being developed.
Okay, thank you, Luc. It's 11:30. I see that there was also questions directly in the chat module. So thank you all for your participation. It's time to close this session. Note that the next webinar session will take place in November on the PPA topic with some ENGIE's experts. So thanks once again for your participation. You will find the replay and the slides of the webinar on our EnergyScan platform this afternoon or tomorrow at the latest. And have a good day all. Goodbye.